Okay, chapter 15, long-term liabilities. For the long-term liabilities, in order liability to be long-term, what's a long-term liability? Liability which is not short-term is a long-term, or liability which is not current is a long-term liability. Then what's the current liability? Liability which is due within 1 year or operating cycle, whichever is longer, is called short-term or current liability. Everything that doesn't meet the definition of the current or short-term liability is automatically considered long-term liability. Which are the forms of the long-term liability? First one is bonds. What is bond? Bond is a formal agreement, that means it has to have a form, between two parties. One is the bond issuer and bond holder. How this works? Usually the bond issuer is the one who needs the money. The bond holder is the one who has the money. So the bond issuer is gonna borrow the money and gonna issue the bond. Bond holder is gonna give the money. It's gonna hold the bond. What's interesting with the bonds? They have a fixed amount with a specific date which is set to be paid back. Plus, on the bonds, you also gonna see the regular payment of interest on the specific date over the life of the bond. So the bond basically is if you're looking from the point of view of the bond holder, is a vehicle that creates interest on the bond issuer or the one who borrows. He's the one who has to pay the interest to the bond holder over the life of the bonds. And at the end of the bond, he has to pay the entire amount that was borrowed in the beginning. Now, the bond payable, that's a group of notes payable, which are issued to the multiple lenders, which are called bond holders. Now, it's the fundamentals for the bonds. First, the bonds always have a principal value. Now, the principal value, you can see it as a maturity value, or as a par value, or as a face value. All those terms means only one thing, principal value, which is the amount that the borrower has to pay or must pay at the maturity. Then we're going to have maturity, which is what's the maturity? Maturity is the date on which the borrower has to pay the principal or maturity value or the par value or the face value. And then we're going to have a coupon rate. Coupon rate is the interest rate that the issuer or whoever borrowed the money has to pay. On the coupon rate is going to stay the date on which the interest payments are paid and the interest rate that has to be paid. We have a different type of bonds. First, we may have a term bond. Term bond is the all maturity, or all the bonds. If you have different bonds, all the bonds they mature at the same time. For example, you may have 10,000 bonds, which will return to 10,000 at the end of the term. Then we have a special bonds. Those are the bonds that mature in installments in the regular intervals. Means, let's say we have $500,000, 5 years, serial bond, and that may mature on the annual 100,000 installments over the 5 years period of a life of that bond. So every year you're gonna reduce the bond with $100,000 until the last year when you paid out. You may have secure bonds, which bonds give the bondholder the right to take specified assets of the issuer if the issuer default or fail to pay principal or interest. Then we have a debentures, which is the unsecured bonds, which are backed only with the good faith. And the last one, we may have a barrier bond, which is bond payable to a person that has possession of them, and they are also called unregistered bonds. Those are the main type of bonds that we may see. Now, what we need to know is how to determine the price of the bonds and how to account for the bonds. First thing that we have to determine is the interest rate. Now, for the interest rate, we're going to have market price of the bonds, the market price of the bond, which is the amount that the investor willing to pay for the present value of the principal plus the interest payments. So basically, the bond's going to give in the hands of the bondholder two streams of cash. One stream is the interest payment on the regular interval on the specified date. The second one is the principal amount which is due at the end of the life of the bond. So by those two cash streams, we have to determine the market price of the bonds today. How much the market is willing to pay for the bond today. In order to see that, we're going to have two interest rates. First one is the interest rate on the bond, which is also stated rate on the bond, or the contract rate of the bond, or the bond rate, which determine how much cash the borrower has to pay to the bondholder. Second one is the market, or also called effective rate. We may see another terms of the market or effective rate going forward. Now, this is the rate that the investor want if they lend their money. So basically, that will be the rate that the market is willing to pay at the time when the bonds are issued. So we have different options for that reason. We have now the bonds in general, they sell at their market price or whatever the investor is willing to pay. For that reason, we have three options. Option one, we may issue the bond at principal value or the par value or the face value or maturity value, which means we're going to get, so once I want money and I'm issuing the bond, one option is I to issue the bond for $1,000 and I to get exactly $1,000. Option two, I issue bonds, which going to pay the bondholder $1,000, but at the time of the issuing, I'm not going to get 1,000. I'm going to get only $980. I'm going to get less than 1,000. That's called bond issue with a discount. Discount in this case will be the difference between the amount that I have to pay in the future at the maturity date and the current market value which I'm getting at the day of the issuing the bonds. The third option is premium. Premium means I'm going to get more today than I have to pay at the maturity. So let's say the maturity I have to pay 1,000, but today I'm getting $1,015. The difference between what I'm getting issuing and the maturity is called premium. In this case, since what I'm getting today is more than what I have to pay in the future. Why those different scenarios exist? Because we have two interest rates. First, we have interest rate which is attached to the bond, which bond's going to give to the bondholder, and the second one is the market. For that creates those three scenarios. First scenario, let's go with the first scenario. I want $1,000. Somebody has $1,000. Now, the market currently pays 6% on $1,000 annual interest. I decide to issue my bonds which pay exactly what the market pays. So in that case, whoever has the money, he's indifferent where he's going to invest his money. Is it going to put it in the bank or it's going to give it to me? He's going to get 6%. So That means the stated value is exactly equal to the market value of the bonds. For that reason, there will be no difference between what I'm going to get, the price that the bonds are issued, or the market price of the bonds versus the maturity of the bond. That's one. Second scenario is everywhere in the market, the lender who has the money, he can get 7%, but I'm issuing my bonds at 6%. My bonds pay only 6% interest. Now the question is, who will be that person who's going to invest his money? He's going to give me $1,000 to me to get 6% instead of going to the market and get 7%. Everywhere in the market, he can get 7%. What's going to make him to give me his $1,000 when I'm paying less than the market? The only reason why he's going to be willing to do that is if I give him a discount. So what will be the discount? You know what? I'm realizing that I'm paying less interest than the market. So instead of giving me 1,000, I'm okay if you give me less, let's say 980. However, on the maturity date, when the bonds mature, I'm going to give you 1,000. So I'm giving him right away at the issuing of the bonds $20 discount, which $20 now is in this case, I know it's hypothetical example, but this case the $20 should cover the difference between 7,000 interest that 7% interest he can get from on the market versus the 6% interest that I'm paying on the bonds. The third scenario is the opposite. Everywhere in the market, the person can get 6%. I'm paying on my bonds 8%. So in that case, everybody will be willing to give me their money to get 2% above the market. Well, if that's the case, if you want so much my bonds, you have to pay me premium. What that means, today, I'm going to issue the bonds for 1,000, but instead of giving me 1,000, I want you to give me $1,015, which will be more than what you're going to get at the maturity of the bonds. And those are the three scenarios. So again, let's summarize it. When the bond interest rate is equal to the market, bonds are issued at the price which is there on the bond. If it's $1,000, we're getting $1,000, case closed. If the bond's paying 9%, but everywhere in the market the investor can get 10%, then we have to give them a discount. Otherwise, they're never going to give us their money. So what we're going to do, at the end of the life of the bonds, we're going to pay them what stays on the bond, let's say 10,000. But today we are willing to take not 10,000 or $950. And the last scenario is if we pay more than what the market, everybody can get on the market. In that case, we're going to get more money today, and we're going to pay at maturity date, we're going to pay the maturity value, which is the face value of the bonds. So now let's see the examples. One example is like this. Bonds price are quoted as a percentage of their maturity value. So for example, a bond, which is quoted 100, is bought or sold on 100%. That means whatever says on the bond, that's how much you're going to get, or that's how much you have to pay. Now, if the bond is quoted 101.5, that means the bond is issued with the premium. If you see the number above 100, which 100 is 100%, or 1, that means the bond is issued with the premium. That means today you're going to get, or you have to pay more money, and later on you're going to get only 1,000. And if the number is below 100, which is 1 or 100%, that means you're giving a discount. So today you're gonna get less than $1,000, and later on you have to pay $1,000. Now we're going to since we're talking about the long-term debt, everything which is over 1 year, we have to consider the time value of the money. What's the time value of the money? The time value of the money is the simple idea that dollar today worth more than dollar tomorrow. The behind logic of this is that today with $1 you can buy more things than you can buy tomorrow with the same amount, with the same dollar. What that means that the price is climbing up. So your money worth more today instead of tomorrow. For that reason, since we're dealing with on the bonds, we're dealing with something which is called future value, or will be the principal that somebody is going to get after a number of years. We have to find out what's the present value of that principal today. Also, we have to account for the interest that we're going to receive above 1 year to see what's the market value of that interest today. So the present value is the amount invested today to receive the more in the future. Future value is on the bonds, you have two components. One is the interest paid. Second one is the present value, which has to be paid after a number of years. Now, the present value, since we have the time value of the money, and we know that dollar today worth the more dollar tomorrow, the present value always going to be less than the future value. Means if tomorrow with $10 you can buy a coffee, most likely today you can buy the same coffee for $9. So again, present value is less than the future value. Why? Because you can buy the things today with the less money than tomorrow. Let's keep with the present value. The present value, the exact present value of any future amount depends on few things. First, of the amount of the future payment, length of the time, after how many days or how many years you're going to get this money, and the interest rate during that period. So now let's start issuing the bonds and see how this is going to go. First thing first, let's assume that this company issue $100 million bonds, which pay 6% interest, and they issue at par. Par means market is also equal to 6%. So whatever they issue, that's how much they get. Interest is paid semi-annually on January 2nd and July 2nd. So let's see how we're going to deal with this. I'm going to copy this thing and I'm going to move to Excel spreadsheet, which Excel spreadsheet, obviously later I'm going to share with you. But before I share it, let me try to zoom some adjustments here on the Excel spreadsheet, and now I can ready to share it with you. Okay, what we have? We have the value of the bond. I'm wondering how to call it so there's no confusions and you can easily identify it. Let's go with the maturity or par value. No, that will be the principal value of the bond. Principal value is also the value that has to be paid in the future. That's 100, 1, 2, 3, and 1, 2, 3, $100 million. Next thing is the period. Oh no, let's go the interest rate that the bonds paid. Interest rate on the bond, in this case, is 6%. Next one is number of the years. That's 10 years. Okay, we have the information. What else we know? How many times the interest is paid? 2 times. So what will be the interest rate on the interest payment? If for the whole year we have to pay 6%, and we're splitting that 6% on 2 payments, that means on the interest rate on the every payment is going to be 3%. The other thing, is number of the years that we have is 10. Let's see what's the number of the periods. How many times we have to pay the interest? If we're paying interest twice a year, so that will be the number of times of interest payments. And that will be 10 years, 2 times a year. We have to pay the interest 20 times. 20 times somebody is going to get interest payment over the life of 10 years. When he's going to get it? On June 2nd and July 2nd, every year. So how much will be the interest payment on the interest payment date? Oh, that will be 100 million times 3%. So every time on the June 2nd and July 2nd, we have to pay $3 million interest payments. That will be January 2nd and July 02nd. Every year. So annual payment will be 6,000, but that's not important. Important is how much we're paying on the interest payment date. So let's issue the bonds. When we issue the bonds, so again, those bonds are issued at par. What that means that the interest paid on bonds, then we have to see where is the market interest rate. And in this case, market interest rate is exactly the same, 6%, which on every interest payment day, the interest rate will be exactly the same, 3%. For that reason, those bonds are going to be issued at par, which means whatever the stated value or the principal value of the bond is, that's how much cash we're going to get today. So that will be debit cash for 100 million and credit bonds payable for the same amount. And that will be on January 2nd. Now let's pretend that now is July 2nd. On July 2nd, what we have to do, we have to pay the first interest installment. So how much we're gonna pay? We're gonna pay $3 million. But what will be the account that we're gonna debit? And that will be interest expense. And since the bondholder they want cash, we're gonna credit our cash with the same amount. And that's gonna repeat every July and January. 3 million and 3 million. Until 10 years from now, where after 10 years, we have to close the bonds. So what that means, we have to debit bonds payable with $100 million, and we're gonna credit one and one account only cash. So that means we're gonna pay the bonds out with cash. I believe I get it right, but let me double check on this. Well, I'm just not copy and paste it. Here we go, 100,000. And that's pretty much what's gonna happen if the bonds are issued at par. Means the market rate, as you can see here, market rate is equal to the interest rate on the bond. Now, that's not always the case. Let's go back now to slides. Again, on the date of the issuing the bond, we're going to get the cash. And we're going to create bonds payable with 10 years bond payable at par, which pays 6% annual interest. On the interest payment date, every July, we're going to start July 1st, 2nd and January 2nd, we have to pay 3%. Why? Because we're paying 6% annual rate, which is paid twice a year. So every time we're going to pay half of it, or only $3 million. After 10 years, on January 2nd, after we pay the interest for that day, we're going to close the bonds by debiting bonds payable for $100 million and creating cash, $100 million. And we're done with this. Now again, not all the time that's going to be happening, but we're going to see different scenarios. So if you have a premium and we have the discount. Now let's see now the other event that might happen is Monte, not you always issue on January 2nd, on the beginning of the year or the end of the year. That's not always happen. The other thing is the bonds might be issued on the beginning of the year or the end of the year, but the person who buys the bonds can buy it between the interest payment dates. What that means, assume that this company issue $200 million, which paying 5% annual interest over the 6 years, and those are dated on June 15th. So every June 15, you're gonna get 5% of $200 million as an interest payment. Now, the issuing date of those bonds is not June 15, it's July 15, which is 1 month after the bonds are issued. So the bonds pay interest for the entire period, for 1 year. However, the first month after the issuing the bonds, there was no bondholder, so nobody held the bonds. Now that raises the question, when the first payment comes, first interest payment comes, how much interest the bond, for how many months the bondholder is going to get on the date of the interest payment, or the interest payment date. Now the bondholder is going to be given the amount equal for the entire year, because again, the bonds is a formal agreement which cannot be changed, and interest has to be paid on the specific date for the period specified. So because the bonds were not issued on the date that they it's not given to the bondholder on the date that they were issued, it doesn't change the fact that the bondholder will get the interest for the entire period, which is 1 year. So is it fair now somebody to hold the bonds for 11 months, but to get interest for 12 months? Because we cannot change the contract, or we cannot change the terms on the bonds. Well, that's not fair. So in that case, what shall we do? It's very simple. When the bondholder get the bonds, he's going to give the cash for the bond, principal amount of the bond. Plus, he's going to give you the cash for 1 month interest on the bonds, which 1 month he didn't hold the bonds. Now you're going to ask me why he has to pay for the month that he didn't hold the bonds. Because on the interest payment date, which will be on, if this is annual bond, or now, no, sorry, the interest paid semi-annually, so that means June 15, that will be December, I believe, December 15. On December 15, the bondholder is going to give the interest for 6 months, even though he held the bonds only for 5 months. Make sense? So what's going to happen? We cannot, again, we're not changing the terms on the bonds, but we asking the whoever give the money and become a bondholder, we're asking the bondholder to pay the interest for the months that he didn't hold the bonds, because at the payment date, he's going to get those money back. So again, the bond pay the interest for twice a year or for 6 months. The bondholder get the bonds 1 month after the issuing. So the interest for 1 month that the bondholder didn't have the bonds, he has to pay us back. Why? Because on the payment date, he's going to get the interest for the entire 6 months. Means the 5 months that he hold the bond plus 1 month that he didn't hold the bond. But since he already pays, so his balance will be 0. Whatever he pays today, he's going to get it back tomorrow as interest. What will be the journal entry? Journal entry will be very simple on the issuing date of the bonds. On the issuing date of the bonds, let's pretend this bond sells for 100,000 bonds 1 month after the bond issuing date. I don't see what's the interest rate here. The market price of the bond July 1st is the face value of the principal bond 100%, so there's no difference between the market and the interest. Now, again, I don't see any interest here that is paid, but let's see here. Is there any information on the, probably those are the same bonds here. Let me quickly see if those are the same bonds or those are different bonds. That will be 200, 1, 2, 3, 1, 2, 3. No, those are completely different. They have nothing to do with that. 1,000 bonds, want interest payment, those are 100,000 bonds, 5%. So the 100,000 bonds that he's selling for $100,000 pay 0.05%, which is 5,000, which is paid semi-annually divided by 2. So on every interest payment, the bondholder is going to get $2,500, which is here. $2,500 is the payment of the interest. Now the bondholder is going to get that $2,500 because that stays on the bonds semi-annually. However, he didn't hold the bond for the entire period. For that reason, we're going to get 2,500. That's the interest payment at the end of the first 6 months. We're going to divide it by 12, and we're going to see how much. Sorry, not this one. We're going to divide it by 2,500. We're going to divide it by 12. Sorry, by 6. And we're going to see how much is the monthly payment on the bonds. And it turns out to be $417. So the bondholder is going to pay us $117 today for the month that he didn't have the bonds. And on the payment date, he's going to get it back. So what's happened in this case? Again, when we issue the bonds are $100,000, bonds payable, but we have the interest payable, which we're going to pay to the bondholder on the interest payment date. So today we're going to get 100,000 and $417. On the interest payment date, we're going to give the $417 back to the bondholder, plus we're going to have the interest expense for the remaining 5 months, because only for 5 months the bonds are outstanding, but in total we're going to pay $2,500. Now let's go with the different scenarios now. I'm going to copy this and I'm going to move to the Excel spreadsheet. Now we start chasing the different scenarios on the bonds. Just give me a second to format my sheet. Okay, I'm ready with this. Let me stop sharing this sharing and let's share my Excel spreadsheet. Here we go. So what do we need to know? A few things. First thing, let's make some changes on the slides because I don't like this interesting rate that they come up with. Let's go with 8% on the market. I'm changing the percentage from the slides purposely so we can make it easy for our calculation. Actually, no, I'm not going to change it because they already gave you the face value of the bonds. So, on the date of issuing, what we're going to do? Our maturity let me see what you're seeing. Yes, you're seeing my screen. I'm going to get this information here. And I'm going to paste it right here. And I'm just going to change the information. First information is the principal value of the bond is $1 million. Then those bonds paying 6% interest for 10 years, but they're paying the interest only once a year. So we're going to have 10 payments. Now, the interest will be every time every year we have to pay $60,000. Now, our market interest rate in this case is 6.27. It says here clearly that the bonds are at 98%. What means is 98% means that we're not going to get $1 million today. We're going to get only 98% of the $1 million, which will be equal to this one time 98%. Today we're going to get only $980,000. So debit will be cash. We're getting $980,000 cash, and we're going to credit bonds payable with the same amount. So after 10 years, instead of 980 what we get today, we have to pay back $1 million. Let's go with not this one, that will be this one. $1 million. So in that case, as you can see, we have a difference in between debit and credit. So we need more debit. Now, debit, we're going to use discount on bonds payable. And that discount is going to be the difference between how much we have to pay in the future minus what we get today. That's 20,000. So that's one way to get it if the percentage of the face value is given to you. And that's happened on January 02nd. Now what's going to happen January 2nd, 1 year from now, we're going to see a little bit later. But that's one way to calculate it. Now I'll show you the other way to calculate it, but let me see if that's part of the slides later or we have to do it now. It's kind of now. But let's leave it the way it is. We're going to explain this a little bit later with how you can do this with the calculator or Excel in this case. We're going to use mostly Excel. That will be, the first one is the par. Second one is discount, second worksheet. Now the next one will be premium. I'm going to grab this and I'm going to move it here and I'm going to label it. That will be premium. So let's go back to the slides and see what the slide says about this scenario with the discount. So when we issue the bonds with the discount, as you can see, we're not going to get $1 million cash today. We're going to get only $980,000. However, at the end of the life of the bond, we have to pay $1 million. So that gives a difference between debit and credit of 20,000, and we're going to debit account called discount on bonds payable. Now, what's interesting with the discount bond payable, it's a contra account or companion account to the bonds payable. On the balance sheet, we're always going to, if it's discount, we're already going to add the discount. We're going to deduct the discount to see what's the value, current value of the bonds. So if we have a 20,000 discount, bonds payable will be 1 million, 20,000 discount. So the discount, the net value of the bonds will be $980,000 on the issuing date, because that's the cash that we get. Now let's see the same scenario, but with the premium. Gonna copy this, I'm gonna move to the Excel spreadsheet again. Let's see what's gonna happen if we have a premium. Again, $1 million bond, we're paying 6% interest over 10 years. Now we're paying once a year. That means 6% at every payment. 10 payments, 10 years, 10 payments. 60,000 we have to pay every January 2nd, July 2nd. The market rate in this case is 5.5. So the market is below what we're paying on the bonds. For that reason, we issue the bond at 103.81. What that means is we're not going to get $1 million. We have to pay $1 million later, but today we're going to get more. Why? Because simply we're paying higher interest than everywhere in the market. So if you want to have my bonds, which pay 6%, where everybody else on the market pay 5.5, you have to pay me more. How much more? $38,100 to be exact. So once we get that, we're going to credit premium on bond payable for the difference, which in this case is $38,100. And our entry is balanced. Let's go back to slides now. Again, premium. Once we do this in general entry, we're going to get the cash, which we're getting here more cash because we simply pay more interest than everywhere in the market over the 10 years. The bondholder is going to get 0.5% more over the 10 years. So for that reason, we're still going to pay them $1 million at the end. But today, if he wants the bonds, which paying 0.5% more than the market over 10 years, he has to pay the premium of $38,100. Now the premium, like a discount, is again companion account or contra account to the bond payable. So what will be the book value? Book value will be the carrying amount of the bonds plus the premium. That means the value of the bonds today as a long-term liability will be over 1 million or 1,038,100. Let's see what is the amortized bond discount in premium by the straight line amortization. So the straight line amortization, before we go to the straight line amortization, one thing that I have to tell you, straight line method is not examined. I'm going to show it to you, but there will be no questions on the straight line method, amortization method. If there's some, that might be some multiple choice questions. What's more important is the effective interest amortization method. Effective interest amortization method, that's the one that's going to be tested. Okay? So let's go now with the...
Sorry, quick question. You said
Yes.
the amortization method will be tested?
Straight line amortization method will be not tested. Effective interest amortization method will be tested.
Okay.
So the straight line method amortization,
Okay.
it's not going to be tested because it's boring. It's just boring. It's very simple, it's boring. But effective interest amortization method will be tested. This is the one that's going to be tested. So straight line amortization method, how this going to work? Let's give that example, give a chance with this example. Let me copy and paste it to Excel spreadsheet. Label straight line method amortization, paste the information here. And let's see what's happened here. We have $1 million bonds, which pay 6% over 10 years at, back to original scenario, at 98. That means the market will be on the 98, the market was 627. So we have a discount of $20,000 in this case. Let's put it in the right place. We need it on the debit side. We're going to have debit discount on bonds payable. What that means? That means that this discount of 20,000, it has to be amortized or moved from the discount on bond payable into the interest expense over 10 years. The question is, how much will be per year? Obviously, 1,000. And every year we're gonna amortize 1,000, 1,000, 1,000 from discount bonds payable into the interest expense. And that's about it. And that's how we are amortizing the discount on the bonds payable over the straight line method. Now, what will be the journal entry here? So this is if we're paying the interest once a year. I'm gonna stay, but here they're saying that they have 20 semi-annual payments. That means they're paying the interest twice a year. So every interest payment is 30,000. So that's, let's say that January 2nd. So the first interest payment will be on July 2nd. On July 2nd, what we're gonna have? We're gonna have debit interest expense. I'm not gonna put the amount yet. Let's see how much cash we have to pay. For the cash, there should be no doubt. We have to pay $30,000 cash every single time. Now, what we're gonna do is we're gonna start amortizing this discount. If the discount is on the debit side, in order to amortize it and bring it down to zero, you have to start crediting that account. So the first period, we're gonna credit discount, a little bit more space here needed. Discount on bonds payable. And that discount here will be exactly 20,000 over 10 years. It's going to be 1,000 per year. Sorry, per payment, not per year, per payment. Per year will be 2,000. And our interest expense in this case on the bonds is not going to be the cash that we're paying, but with the cash that we're paying plus the discount on the bonds, or $31,000. Why didn't catch it? Oh, because I put the wrong cell. $31,000. And that entry is going to repeat until the very last payment of the interest. Every interest payment, we're going to have interest expense of $31,000, cash paid $30,000 because by the contract that we made on the bonds, we have to pay exactly the same amount, which is the principal is the same, interest is the same, per payment is the same, so we pay $30,000. And 20,000 over the 20 years is going to be amortized. So how the T account is going to look for the bond, no, the discount on the bonds premium is going to look like this. If you want to see it, it's going to look exactly like this. That will be our T account. Now, beginning balance here will be 0. Obviously will be 0. The name of the account, discount on bonds payable. Then on the January 2nd, when we issue the bonds, we're going to have 20,000 discount. Then on July 2nd, we're going to amortize 1,000. And sorry, should be like this, and that's the first payment. And that amount's going to continue for the next 20 payments. Then it's going to be somewhere here, 20 payments. So 20 times we're going to have $1,000 discounts. We're going to be here, 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 and one more time here. That's July. The other one will be 1,000. That will be on January 02nd. Now it's not gonna let me, but we can make some adjustment here. And on the 20th payment, once we reach 20 payments, we're gonna close the discount and the bond's gonna stop existing. So our ending balance, it's gonna be equal to the balance of January minus sum of all these payments all the way to the end. So our ending balance is gonna be 0. That was the objective here, to amortize the entire discount over the life of the bonds. And we actually meet our objective. But using the straight line method for the amortization, so we amortize the 20,000 over that will be here 17, 18, 19, 20, over 20 periods or 10 years until it becomes 0. Once we amortize the discount, the only thing that left on January 2nd, after 10 years, gonna be debit bond payable for $1 million and credit cash for the same amount. And we're done with this. That's why I'm telling you, straight line amortization, not examinable. Too boring. Let's see what will be examinable. Effective interest method will be examinable. Again, the straight line method, it's going to be every year we're going to deducting 1,000, 1,000, 1,000, 1,000 until we amortize the entire. This example I'm not going to go over since it's the straight line method. I'm going to go directly to the effective interest method. Questions up to this point?
So the effective interest method is different in the sense that it goes into basically, sorry, I'm just reading here. It goes into how to do it, but in a different way. Is that correct?
That's correct. But at least at this point, we cannot make any conclusion because you don't know it yet.
That's what I was thinking. It was a bit
Yes,
odd.
right. So let's do it first, and then we're going to compare effective interest method with the straight line method. Make sense? Now, before I jump to the effective interest method, do you want 5 minutes break? Effective interest method for amortization for the bonds. Now, what that means is that each interest expense will have the same percentage based on the bond book value for the every interest payment over the life of the bond. So basically, we have to calculate the interest expense every time when we have effective interest method. Effective interest method better matches the interest expense to the revenue that we are earning, and international financial reporting standards require effective interest method. Accounting standard for the private enterprises, you can use straight line or effective interest method. But if you're reporting international financial reporting standard, which is the objective of the 3000 level course, you will need effective interest method only. So let's learn about this method so you can have a little bit easy semester when you move to the intermediate financial reporting. First thing first, let's teach you how to calculate present value of the bonds. I'm going to use this one. I strongly suggest you to download the Excel spreadsheet that I just posted, and let's move to that Excel spreadsheet that I just posted. Move to the worksheet that says effective interest method amortization and post. I'm going to post this. If you want to work with me, work with me. If you don't. So first thing first, actually I don't like this. Just give me a second. I want to change it a little bit. I'm just going to grab this information, very selective information, and I'm going to post it here as a picture again. Is it going to work? Probably not. Now we're going to assume that on January 2nd, 2003, this company area 11, I don't like this. Area 24, okay. For this company, and let's move it to the no cover. This company issue 1 million 5 years bond. This bond pay 5%. Pay 5% bond at the time with the market interest rate. So now I want when the market interest rate is 6%.
Sorry, Ivan, we can't see your Excel and you're
Just a
not
second.
recording. Oh, sorry,
Just
thanks.
just a second. I'm just gonna show you the Excel. I just want to make some adjustments on the requirements. So basically, I'm just reading at the moment the requirements. Okay, now I'm ready. I think recording is going, is it? Yes, the recording is going. Let's share my screen now. Boom. And now you should see my screen. There we go. Now I have the question. Now assume that on January 2nd, 2023, this company issue 1 million 5 years bonds, which pay 5% at the time when the market rate is 6%. The interest is paid semi-annually. So let's start digging the information. First, principal value is 1 million, no questions about it. Second, these bonds pay 5%. The number of the years is 5. The bonds are paying, the interest is paid 2 times a year, semi-annually, so 2 times days. So the interest rate on every payment on the interest will be 2.5. Number of the interest payment that we have to make over 5 years will be 10. That's going to give us the interest payment of 25,000 on the every interest payment date. Now, our market rate is 6%. Now I don't need this one. Now we have to find out what's the present value of the bonds. which are issued at $1 million and paying semi-annual payment of $25,000 10 times over the life of the bonds. What we're gonna do, we're gonna use the Excel, the formula from Excel. Before we do the formula of Excel, let's think a little bit. Our effective interest rate is the market interest rate. So for our formula and our purposes, that will be our I/Y or interest rate. Or in other words, that will be our rate. Next thing, that will be our interest payment or also known as a PMT, payment. Number of the times that we're paying the interest will be periods, not the periods, that will be N. Yes, that's number of the periods. So, but I have to check exactly how it's in the formula, and then we're going to change the name. But at this point will be, let's call it periods. I cannot remember exactly what is. And the last one is the value, the face value that we have to pay after 5 years or 10 payments of interest of 25. That is called future value. Once we have those in mind, now let's go and use the formula. Which formula we're going to use? We're going to go on the financials, click down, and you're going to scroll down until you see PV, which is the present value. So, then we're going to start filling the gaps on this chart here. First one is the rate. As you can see here, you can see the explanation. I'm not sure if it's going to make it bigger. It doesn't make it bigger. Unfortunately, if you click Control and scroll it up and down, it's not going to make it any bigger. But anyway, first one is the rate. Rate is, this is the interest rate per period, not per year, per period. For example, use 6% divided by 4 for quarterly payment of 6% IPR, annual rate. So in our case, annual rate is 5%, but I don't have to divide it by 2 because I already have it divided by 2. So what I'm going to do is I'm just going to pick here the rate which is applicable to me. The question is now which rate? The rate will be on the market. I'm going to use the market rate. Now, before I start doing this, I have to do some adjustments here to see. Let him insert one more, and here the market rate per payment. And that will be equal to the, since I have 2 payments per year, that will be 6 divided by 2. So they're gonna give me 3, and I'm gonna change this one and gonna put it right here. Now I can start using the formula. Let's go again, financial. Scroll down until you see PV. Once you see the PV, now I'm in the right scenario. My rate, either you have to enter 6 divided by 2, either for simplicity, just enter 3. Number of the periods. How many times you're gonna pay interest? 10 times. How much is the payment of the interest every time when you're paying the interest payment? It's 25,000. How much is the future value? So now, how much is the future value that you have to pay after 5 years? It's $1 million. Now, the last thing that I'm gonna ask you is type. So every time when you click on the rate, it's going to give you the example. What's the rate? N, number of periods payment per investment. PMT is the payment made each period. And that cannot change over the life of the investment. So that payment is exactly the same over the life of the investment. FV is the future value or cash balance you want to attain after the payment is made. And the last one is type. This one is the logical value. If we pay the interest at the beginning of the period, we have to put 1. If the payment of the interest is at the end of the period, we don't have to put anything, or we have to put 0. In this case, we're not going to put anything. Now, the last thing that I want you to do is, where it says payment, since this is a point of view of the cash outflow, payment is the cash out. So we have to put minus in front to go out. Future value is also 1 million, also is the amount that we have to pay. So we're going to put another minus here. And that's how we get the positive amount, which the cash that we're going to receive today. So if I click OK, so the cash that I'm going to receive today is going to be equal to $957,348.99. So if you want, we can round it. Let's go home and let's round it to the round number. That will be $957,349. This is how much we're going to receive. What's the market value today of $1 million that has to be paid after 5 years, plus 25 payments of $25,000 over 5 years, where the market rate is 3% or 6% annual basis. So the cash that we're going to receive is that much. How much we have to pay at the end of the life of the bonds? We have to pay the principal value, which is 1 million. That leaves us with the discount of $42,651. So this is the amount of the discount that we have to amortize over the life of the bond. Now, how are we going to do this? At this point, we can prepare amortization schedule. Stay with me. I want you to do the amortization schedule with me. If you follow me, you'll be fine. If you don't want to follow me, don't follow me. But later on, if you try to do it, you might have problems. So for that amortization schedule, I can delete those ones. So for this amortization schedule to work, we have to have certain columns. First columns will be the periods. We already know we have to pay this 20 periods. Sorry, 10 periods. So we're going to have, first we're going to start with 0. 0 period is the one that we issue in the bonds. And then the first period is July 1st, and then January 2nd, and keep going, keep going, keep going. And we need 10 periods right here. I have the column with my periods. Second one will be balance at the beginning of the period. Obviously, our balance here will be 0 because we haven't issued the bonds yet. Next one will be the payment. The question that I want to ask you and you to ask yourself, do you know how much interest you have to pay? That will be interest payment. Do you know how much interest payment you have to pay each period? What you gonna say? Do you know or you don't know?
Personally, I'm a bit lost, like how you got the Excel and so on. It's been a while since I've used it, but no, I understand that like you went to the formula tab and like clicked on insert functions.
No, I'm asking here. Do you know the interest payment before you start doing anything? How much interest you have to pay each January and July 2nd?
Technically, interest means interest equals principal times the rate times the time.
Correct. So do you know how much interest you have to pay every interest period?
Yes, it's given. I'm guessing this might be a bit of, I might make a mistake here, but like I'm gonna try. It would be semi-annually, so like the
Do you see my screen?
yeah, I do. Oh,
How much is it? 25,000.
25,000.
Do you know it for certain? Absolutely.
Yeah.
How this gonna change from period to period? It's never gonna change. So this one will be equal to that amount, and that's gonna stay forever. I mean, for
Okay.
the 10 period. If you want, you can see how much interest you're gonna pay at the end, and that's gonna be equal to, let me see the amount sum. So over the life, you're gonna pay $250,000 interest. Next column will be interest expense. So the interest expense in this case will be based on percentage, but based on the market. We're gonna calculate the interest expense based on the market. Do we know how much is the percentage for the market for the every interest payment? I believe we know it. It's already given to us, and that's 3%. We're gonna come to this calculation a little bit later because we need the balance in order to calculate this. Next column will be simply difference. Difference between the interest expense and interest payment. Next column is gonna be our discount. And the last column will be our balance. At the very beginning, do I know how much is my discount? When I issue the bonds, do I know how much is my discount? Obviously, I know. Where should I look? I should look right here. And that will be my discount right there. Let's make it the same format. And let's highlight it in the same color so you can easily see it. That's my column for the discount. For the discount, what's the objective here? What should be the total amount of the discount at the end of the life of the bonds? It should be zero, correct? At the end of the life of the bonds, I shouldn't have any discount left. Now let's see the balance. What's happened with the balance? Balance, I'm gonna highlight it in green. This is my balance, present value, or the cash that I'm gonna receive. My balance starts with this amount. How much I have to pay at the end of the life of the bonds? Do I know before I even start my calculation? The answer will be yes. We know that amount, and that amount will be $1 million. So I'm plugging this amount here. This is my objective. The discount to become zero, balance to become 1 million. Here, if you want, you can add another column, and that will be your check. What will be what you're checking? Every time the discount plus the balance should be equal to the maturity value of the bonds, or $1 million. So every time when you're getting the discount plus the balance of the bonds should give you $1 million. Let's highlight this check column with some other color. That will be that one. Now we can start doing the calculations. First calculation will be first line. My balance is the beginning balance, which is the ending balance from the previous period. I'm paying 25,000. My interest expense will be equal to the balance time the 3%, which is the market rate. And I'm going to lock it because I don't want that to change. I'm going to lock that interest with F4. So this always going to read of the 3% is going to calculate the 3%. Now I can make it without the zeros. Now I can calculate the difference. My difference is this one minus that one. Now what I'm going to do with the difference? That difference is going to go to the discount, and I'm going to add it to the discount. Sorry, well, I'm going to start deducting from the discount. So what I'm going to do, that the new discount left will be this amount, the beginning, minus the difference. What will be my balance? Balance will be equal to the previous balance plus the difference. What I expect to see on the check? I expect to see on the check 1 million. If you don't see $1 million, you're making a mistake. Now the next period, beginning balance is the starting balance of the period. 25 is my payment. Then I have to calculate the interest. Will be the beginning balance time the 3%. That's going to give me, let's get rid of those. Actually, all of those I want to be like this. My difference is always going to be the interest expense minus the payment. That amount I have to deduct it from my discount to bring the discount to zero and start adding it to the balance or the remaining balance on the bonds. When I run the check, I have to see $1 million. The next thing that I can do is just copy those cells. Interest, since I logged the interest percentage, I can scroll it down. No, I didn't. Here I didn't lock it, so let me lock this one. And now I can scroll it down. Next one will be the difference. Scroll down the difference. Next one will be the discount. Scroll down the discount. This one minus this one. And the last one is the balance. And the last one is my check. And my amortization schedule is done. As you can see, I met my objective. My objective was to amortize the discount to bring it to zero, to increase the value of the bonds from the cash that I get, the market value, all the way to the maturity value, which is $1 million. And everywhere in the middle on my check to be 1 million. So what I have to do is start doing the journal entry. First journal entry will be on July 2nd. What I have to do on July 2nd? I have to show debit interest expense. Now, interest expense, I purposely gonna highlight it with the color of the interest expense, so you can actually see it from where it coming. And the interest expense on the first period is equal to 28,700. this amount. Let's make this entire, eliminate those zeros, and those one eliminate those zeros. Next thing that I'm gonna get is the payment, which will be credit cash. For the payments, I purposely gonna highlight in the same color that this one is. I believe that's the one, and that's gonna be 25,000. That's never gonna change. I already know the cash never gonna change. Every period I have to pay these people $25,000. Now, as you can see, I have a discrepancy between debit and credit. That discrepancy is related to difference. So what I'm gonna do with that difference? I'm gonna start eating my discount. So that will be credit discount on bonds payable. And how much I'm gonna put there? Now the difference, I should cover it a different color. What will be the color that I can use here, which will be different than everything else? Let's go with the yellow color. That kind of yellow color, and that will be my yellow color here as well. And that discount is gonna be this amount. And that's the only way I can get the just journal entry working. And now I'm in balance. What's going to happen on January 2nd? Pretty much the same thing. Let's copy this format. I'm going to put it right here. And here we're going to collab January 02nd. January 02nd will be the second period. On the second period, I'm going to have exactly the same names. My cash will be exactly the same. Now my interest expense is going to change. It's going to start getting higher. Why? Because I'm starting discounting more from my discount. And I keep going until the period 10 when I eliminate all the discount. So what's going to happen with the discount? With the discount, it's going to happen pretty much this thing. So if you want the T account for the discount, it's going to look like this. Discount on bonds payable. Let's leave it here. And that will be, in this case, we need only 10 periods. Let's leave it here to the 10 period. I don't need this. I don't need this ending balance here. So my beginning balance will be 0 before I issue the bonds. Once I issue the bonds on January 2nd, here, my discount value will be 42,651. After that, I'm going to start discounting that amount. So let's format these cells. And my ending balance at the end, it has to be 0. So once I getting my ending balance at the end of the 10th period, because that's 1, that's 2, all the way to number 10. And my ending balance should be equal to this amount minus sum of all those amounts. And the balance is 0. The same thing that shows here on the amortization schedule. After I do this, so basically after we repeat this entry 10 times by changing the interest expense, as you can see, the interest expense is going to start climbing up. The discount is going to start going down. The balance remaining on the bonds is going to start climbing up as well to reach 1 million. Once we reach that at the very last payment, we have to pay the 1 million bonds payable and credit the cash for $1 million and we're done. That's when we have effective interest method amortization on the discount. Don't worry, I'm going to post you this chart so you're going to have it. The good thing is this is the first time that I'm doing it with different colors.
So this is going to be this document, you will post it online, right?
Absolutely.
Okay, that's good relief.
I can even update it right now as we speak. So if you go to the same place that you saw that the previous one, I can update it. The same Excel spreadsheet that was sitting there. I can edit the file and so not this one. I want to, what I want to delete this one and post a new one, which is I just created. Save, and you have it right now. Or it's already there with the colors and everything. The Excel spreadsheet that you see on your screen, you already have it available. Now let's do the next. Now the next one, I'm gonna copy this discount. Next scenarios obviously will be the premium. Before we do the premium, let's go to the slides and see what the slide's telling us about the discount. I'm gonna stop sharing this and gonna move to the slides. So as you can see on the slides, once they do the calculation, they're gonna come up with exactly the same numbers or close numbers to what we have. Let me see if we exactly the same numbers. We exactly the same numbers, in fact. That's the first journal entry. After that, we're gonna start calculation of the interest expense. Again, payment always gonna stay the same. 25,000 always gonna stay the same. Interest expense will be calculated based on the balance times the market rate divided by 2. And the difference is gonna go to the discount on bonds payable, which you start deducting. So how this is the amortization table, which we already created. Again, the objective here is to bring the discount to 0, the carrying value of the bond to 1 million. Payments always gonna stay the same. Interest expense, as you can see, is increasing. The discount reducing, carrying value going up. Again, those are the explanation on which column what you have. Do you have to memorize it? It's up to you. But now, once you have the Excel spreadsheet, just follow my Excel spreadsheet, you'll be fine. So what you can see on the effective interest method when we have a discount. First, as we already saw, the interest expense every period is going to start increasing. Second, the carrying value of the bond is going to start increasing, going up to 1 million. The discount, which is the market value of the bonds at the day of issuing, and the book value of the day of the payment, is going to start shrinking until it becomes 0. Now let's see premium. On the premium, I'm just going to copy this first sentence and I'm going to move again to the Excel spreadsheet. In the Excel spreadsheet, it's going to look messy, but you're going to see later, slowly, we're going to get to the point that it makes sense. Let me share my screen first. So what I'm doing is I'm going to post here the question. Now we're assuming that on April 30th, now it's April 30th, this company issue, let's see what they issue. Let's following the same format actually. This company issued, let me delete those one. Issued 1 million 5 years 5% bonds. 1 million 5 years bonds that pay interest semi-annually. Let me see what says on the market rate. Where is the market here? The market rate stays is 4%. So our market rate is 4%. So what we're going to change, we're going to change few things. First, it's still $1 million. We don't have to touch anything. 5% bonds. Let me delete this one. First. I'm going to delete this one and going to do some changes. But I can easily erase everything and we'll see how this is going to go. Okay, $1 million, no questions about it. 5%, 5%. 5 years, 5 years. Semi-annually, 2 times per period. Which means every period we're going to pay 2.5%. Over, now the periods instead of 5, payment of how many times we're going to pay that 2.5? 10 periods. How much will be our payment? 25. So we have my interest payment for the entire amortization schedule. The next thing is the market interest rate. That will be a rate. Market interest rate. Market interest rate in this case is 4%. That means on the every payment of the interest, the effective market interest rate will be 2%. Now let's see what will be the present value of the bond. So what should we expect first? First, where is the market? 4%. Where is our bond? So our bond is 5%. Our bonds pay more than the market. So our bond will be attractive because people who were investing in the market, they're getting only 4%. If they invest in our bonds, they're going to get 5% interest guarantee over 5 years. For that reason, we can issue our bond with a premium. Make sense? If the market is here and the interest on the bonds is here, now we have to give them discount. But if the interest on our bonds is higher than the market, we can charge premium. Let's see how much will be the present value. So we expect our present value to be more than $1 million. Let's see if that's going to check. Again, we're going to the formulas. Pay attention now. We're going to the formulas. We're going to financials. We're scrolling down until we go to the point of present value, which is PV. We're going to click on the PV and we're going to start filling the information. First, going to ask you for rate. We already know the rate will be the market rate per payment. So that's 2%. Next thing is the number of the periods. How many times we're going to pay this interest? 10 times. 5 years, 2 times per year. That's 10. That's our 10. How much we're gonna pay on every payment of the 2.5 interest? 25,000. What's the future value at the end of the life of the bond? How much we have to pay back to the bondholders? $1 million. When we're gonna pay everything? At the end of the period. So in this case, here we don't have to type anything. The next thing that we have to change is, since we're talking about the outflow, we have to change we have to put one minus on the payment. Payment is outflow. Future value, $1 million. We also have to pay it out. That's outflow too. And once we click OK, we're gonna see how much is the present value of our bonds. And as you can see, the present value of our bonds come up higher than the amount that we have to pay at the end of the life of the bond. What that means? That means we issue our bonds with premium. How much exactly is the premium? $44,913. So now I have to do some modification here on my sheet here. So what I'm gonna do is I'm gonna delete this one and I'm gonna move it up a little bit. Like this. So I'm gonna have my cash. I'm gonna get 1,044,930. I have to pay 1 million at the maturity date, which is the principal value of the bond. Now I'm gonna have a premium. So I need one line here. I'm gonna insert and push it down, which is the line for the premium. As you can see, that premium is gonna be now on the opposite side. It's not like a discount on the debit side, it's gonna be on the credit side. Credit premium on bonds payable. And that will be exactly this amount minus 1 million. So what we're gonna do here? I can put the premium on the bonds payable in the color to be pinkish again. Let's go with this pinkish color. And instead of discount, I can change it here to premium. Let's start filling the gaps now on the amortization schedule. First thing first, do I know my interest payments for until the end of the life of my bonds? Yes. How much is that? We can easily see it in the same color. It's 25 and sitting there and waiting for us, 25. Also, I can scroll down this 25 and that's how much I have to pay over 10 years. There's no questions about it. Now, the next thing is the interest. Interest, I have to pay it based on the market, which is the effective rate, 2% of every interest payment. So I have to calculate it based on my balance. Before I go to the balance, difference, we have the column for the difference. Let's go to the premium. Do I know my premium when I issue my bonds? Let's see what you're saying on the chat. Yes, I know my premium. My premium is equal to 44,912.93. Let's make it a round number for simplicity. Next thing, do I know my balance on the bonds? Carrying value of the bonds, if you want it this way.
It's 1,000, actually
1,000,000.
1,044,913.
That's correct. That's the present value. Or now on my check account here, on my check, what do I have to do now to bring it down to 1 million? Because don't forget, the carrying value of the bond is 1 million. How can I get 1 million between those two numbers? Do I have to add it or deduct it now? Deduct. That's the adjustment that you're going to make on the table. So now on the check side, we're going to have the balance, carrying value of the bonds minus the premium. And that's going to give us, no, the opposite way, sorry. That will be equal to balance minus too many is equals minus the premium. And that's going to give me my, doesn't give me anything because I'm playing with the formulas here, minus this one, it's going to give me $1 million. Now this balance is going to become my beginning balance. On that beginning balance, I'm going to calculate my interest expense. This one time the 2%, which I'm going to lock. Now I'm going to have the difference between the payment and the interest expense. Now, what's my objective for the premium? What should be the ending balance of the premium? 0. What should be the carrying value of the bonds? On my schedule at the end of the period? How much I have to pay? No. That's how much we're going to get. How much I have to pay at the end of the life of the bonds. What's the principal value of the bond? How much is my bond payable? Can you see it? 1 million. So my objective is to bring the carrying balance to $1 million. Make sense? So what do I have to do with the difference in order to start reducing the premium and bring it to 0? Add it to the premium or deduct it from the premium? What you gonna say? Deduct. There should be no questions, Monica. Because if we're adding it, premium's gonna go up and never gonna reach 0. So you have to start deducting it. So premium minus the difference. How about the balance? How can I bring high balance down to 1 million? Adding or deducting? The difference again. Deduct.
Left.
So that will be my balance minus the difference. What I'm chasing here, I have to change those formulas because right now it's on the plus. Let's change those formulas. Did my check? Do I have 1 million? Yes. So everything's fine. Let's do the second line. Second line is I'm bringing the balance from the previous period. Interest payment, no questions about it. I have to calculate the interest expense, which will be the balance time 2%. Let's log the 2%. It's going to give me that amount. Then I'm going to get the difference, which will be the payment minus the interest expense. It's going to give me that amount. How do you lock it? Very simple. Watch this. Good questions. I didn't know how to lock it. Don't get me wrong here. So what you can do is put the formula in getting this balance. I don't want this one to be locked because I want when I drag the formula, this number, this cell to go down with the formula. But I don't want the 2% to change. I want to always to read from this cell. What I'm gonna do is you're gonna get to the number here, to the cell on the formula. Can you see it on the top? On the Excel spreadsheet?
Yeah, I can see it.
You're gonna click there and you're gonna hit F4.
Alternatively, if you're using a Mac, you should put a dollar sign between the
That alternative,
let
yes. But if you press F4, automatically put those signs on the both, on the cell, on the column and the row. So I lock my cell.
Okay.
Make sense? Then the premium. What we're doing with the premium, we're deducting, right? Because objective is to premium to go down minus this one. Same thing with the remaining balance. We're deducting from the remaining balance the difference minus this one. And the check is done. So once I have this, I can easily grab those cells and scroll it down. And we'll see what's going to happen. And we're done. Our objective is achieved. My balance on the bonds payable, carrying balance went to $1 million. I get rid of all the premium and I have my interest expense. Now, what can we observe from this, purely from this chart here? Interest expense. First, the interest expense is less than the interest payment. Second, interest expense over the life of the bonds getting less. Why? Because the balance getting less. Premium going shrinking, and the balance, the carrying value for the bonds also shrinking to 1 million. So if we have to do now the journal entry, since I made it to read from the previous, it's going to be pretty much the same except the difference. Now the difference, instead of the discount, we're going to, instead of crediting, now I have to debit it because I have the discrepancy on the debit side. So that will be debit premium on bond payable. And that premium is going to be equal to exactly the difference. Next period, same thing. And this one will be exactly the same. And this entry is going to keep repeating. On the T account, instead of discount, we're going to change it to a premium on bonds payable. Now the beginning balance, as you can see, is not going to be debit in this case. The beginning balance on the premium starts with credit. That will be zero beginning balance, obviously. And then not on this date, now on the, what was our date here? On April 30th, we're going to pay that cash. Then April, then we're going to have May 1st. And then we're going to have May, June, July, August, September, October, November 1st. We're going to pay the next one. So our beginning balance here is going to start with $44,913. And we're going to start amortizing over the life of the bond, but this time will be on the debit side. Now let's make it without zeros. Our objective is to bring the ending balance to zero. So basically our formula here will be what we have in the beginning minus sum of all those numbers. And let's see if that's going to bring us to zero. Yes, that's bring us to zero. And our job is done. Now, what's going to happen on the end of the life of the bond? At the end of the life of the bond, we're just going to pay the bond $1 million, debit bond payable, credit cash. So that will be on April 30th, 5 years from now. April 30th, we're going to have debit bonds payable for $1 million. And credit will be cash for the same amount. That will be April 30th, we said. And we're done. Now, what I want you to do, very simple. Let me post this Excel spreadsheet so you can have it too. The same place is going to be on exactly the same place that the previous one was. I'm going to erase the previous one and you're going to have the new one. Calculation from today. Let's edit this one. Let's delete what we have here. And let's upload the new one, which is I just saved. And you have it available. So what I want from you is very simple. Every time when you have a bond calculation, and you have to use the effective interest rate, what you have to do? Open the Excel spreadsheet, plug the information, calculation should fill up itself. Make sense?
So basically take the Excel sheet, then plug in different numbers, like if we have.
Yes.
Okay. Okay. And do the same for the final exam as well online, right?
If you want to do this on the assignments that you're gonna have, the intermediate financial reporting, still gonna work.
Okay. Thank you.
So one thing that I want to show you is this, and I want you to pay very close attention here. So I want you to understand the logic of all the calculation and time value of the money. I purposely flip this one here. That will be the exercise. So for this exercise, what we're going to do is I'm going to log this information. Do you know how to log these cells without this so they cannot change? You can simply copy it and paste it as a value. Now, those numbers, they're never going to change. Whatever I'm changing, because those numbers originally reading from this calculation, now they're not going to change. So let's say you want to check yourself. Let's say if you want to check yourself, is this table, amortization table, is actually correct? And what exactly I want to check is this balance actually accurate? So I'm going to highlight this number here. Purposely, I'm going to highlight it. And we're going to do the calculation. So what do I expect here to see? I don't need this thing. I'm going to erase those ones. I don't need them. This exercise is not about any of those, so I can easily delete those. Okay, those one gone. So I want to check, is this table make sense? So is this balance accurate? Now remember, this balance is at the end of the period. At the end of which period? How many periods already pass? 1, 2, 3, 4, correct? How many periods left? Six periods left, correct?
Yeah.
So the question is, I'm paying semi-annually. So basically, I have only 6 periods left. So if my 6 periods left, on which I'm paying, which principal is $1 million, I'm paying $25,000 on the each payment, which the interest rate is 2%. If I run this calculation, is the number here that I'm get, we're gonna match this number. Let's see what's gonna happen. So I adjust my periods, 6 periods, based on this number. I have only 6 periods left. So let's see what will be the present value of the bonds. Again, we're gonna go to the formulas. We're gonna plug the financial. We're gonna scroll down to present value. And we're gonna start plugging the number. Rate is 2%. Number of the periods now left is only 6. Payment is still the same, negative 25,000. And the future value that they have to pay is still the same, $1 million, negative $1 million. How much is my present value? Is it exactly the same what the formula says?
Yes.
Can you see it? So what you're telling me, if I plug here, if I have only 3 periods left and run the formula, my formula here should show me this amount, correct? Let's see if that's going to happen. Let's plug now to 3 periods. I'm going to change only the periods. Run the calculation. Exactly the same. So now, do you see the link between the calculation here and the chart that we created?
They match perfectly up to it.
They match perfectly. So what you can do is, if I have those periods like this, what I can do is I can go here and paste it as a numbers. I can go and sort them on the largest two. No, I want to continue with the current selection only. So at this point, I know exactly how many periods left if I flip the number upside down. Make sense? Can you see it? So what I can do is, if I have 10 periods left, my value should be here. If I have 10 periods, my value is this one. If I have 5 periods left, my value should be this one. 5 periods, my value is this one. 5 periods left. If I have 2 periods left, my value should be here. 2 periods left, my value is here. So there's a correlation between this calculation and this chart. Now this is for the premium. Exactly the same is for the discount. Make sense? I want you to see this. That's how you can jump from one period to another period. So try to play the same, do the same thing with this is exercise for the premium. Now, once you have the premium, I'm going to post you this as we speak again. Once you have this for the premium, try to do the same thing for yourself. Play with this Excel spreadsheet and do the same thing for the for the discount. Let me upload again this Excel spreadsheet. Okay, upload, save. It's available for you now. You have it available for you. All right, now let's move. Do you guys? No, there's no time for break. Let's go to the slides. Let's move back to the slides. And let's finish where we stopped on the premium. So once we do the calculation, we're gonna see the premium of 44,913. So on the first interest payment, what we have to do based on that amount, we're gonna apply the 2.2% interest. 4 divided by 6 divided by 12, that's 1.5. Divided by 4, that's 2. We're getting that one. That will be our interest expense. Interest payment never going to change, always going to be 25. The difference will be the premium on bonds. When we run the amortization schedule, it's going to be exactly the same that we use so. Now, this is the explanation of different columns, how we get the columns. But when you have the Excel spreadsheet that I just posted you have it with the colors. And you can see which one is what and where is going on the journal entry. Now, on the bond premium, what was interesting here is compared to the discount, interest expense getting lower, where the carrying value reducing from 1,044,000 down to 1 million, which eats all the premium. Now, on the presentation on the balance sheet, we always have to separate current from the long term. So what will be the current portion of the long-term debt? The portion which is payable within 1 year. Everything which is payable over 1 year, from the point of doing the report, it's a long term. So what you're gonna see that how the long-term portion of the long-term debt start shrinking every year, but the current portion, if you have the same payments year over year, the current portion is gonna stay the same. Until the very last year when the long-term portion is going to completely disappear because the last payment, it will be due within the current year. Adjusting entry for the straight line method, that's not examinable. We're going to skip this one. So what's going to happen if we have adjusting entry? Actually, we're going to do the accruals. What's going to happen if we have a reporting date within the payment date of the interest? Pretty much the same thing that we're doing with the bonds. The only difference is you have to make accrual for if it's on the discount, you have to make accrual for the interest expense and the amortization of the discount. There will be no payment of cash. That's going to go to the interest payable. And on the actual payment of the cash, you're going to close the interest payable. You're going to add the next portion of the expense and the next portion of the discount. And you're going to pay it cash. Question for you. I want you to see this question here. We have the stated rate on the bond 5% and the market is 4%. Do we have a premium or discount? What do you think? It already says here, so you should just read it. Premium, of course. It says here premium. But again, see where the market is. If the market is below the stated rate on the bond, premium. If the market is above the stated rate, discount. If they're equal, nothing. No premium, no discount. So on our table, let's go quickly over the Excel spreadsheet so I can show you this. On our table, amortization table that we already have. Since the difference between payment 1 and payment 2 is 6 months, correct? So what we have to do? We have to get the interest expense. So what we have very quickly, let me show you here. We're going to have the payment on the May 1st, November 1st, and then we're going to December 31st. So interest expense is going to be equal to that amount on the May 1st. No, that's the issue of the bonds. That will be November 1st here. November 1st. Interest expense gonna be here, the difference gonna come here, and the payment's gonna be 25. Now let's see, let's do the accrual for December 31st. Now from November 1st to December 31st, we have 2 months pass. So we have to show the interest expense for 2 months. Now on the second period, we on this line now, and we're working with these numbers. So if we're doing the entry at April 1st, April 30th, on the April 30th, what we're gonna have? In reality, we should have this amount. The premium should be this amount, and the payment 25. No questions about it. Now we're gonna split this entry on April into 2 entries. How are we gonna do this? We're gonna add here debit interest payable, and that interest payable is gonna come on December. Interest payable. Now remember those numbers. These are the numbers that we want to achieve. That cash gonna stay. Cash is not our problem. Our problem are those 2 numbers. So what I have to do with these numbers? Those numbers are for 6 months. So let's get it for per month. This one divided by, divided by 6. And that will be the next one divided by 6. So when I get rid of the zeros, those are the numbers that I'm getting. On the first part here, I have 2 months, only for November and December. So my numbers here will be this one time 2. Get rid of the zeros and make it bigger. And the next one will be like this. So now I have my numbers. What I have to do, I just have to plug the information for 2 months. For the 2 months, I'm gonna have interest expense. So let's see which color is the interest expense. Interest expense is this color. Let's stay with the colors. And this is my premium, which was yellow. And on the premium, I'm gonna have this amount for 2 months. That's not gonna be interest, and that's not gonna be blue anymore because that's not cash. We're gonna go to green. And this will be our also green. And that will be those 2 together. I can easily call this one. This one's gonna be those 2 together. That's for 2 months only. Now what I have to do, I'm gonna get this information here. I'm gonna put it here. And now I need it for 4 months. And the 4 months gonna come right here. This one is here. This one is the next one. The payment is 25. But that green is gonna close this green, so this one is gonna be equal. Now the question is these 3 numbers equal to 25? Yes, they are. Our job is done. We split this number into 2 entries. one entry is for 2 months, the next entry is for 4 months. Make sense? When you get this total, the total between those two numbers, 25, equal with the total of those two numbers. So this one is going to be equal to this one plus that one, and also 25,000. That's your checkpoint. That means you're working perfect. When you get this number and this number, that should give you that number, 2816. 2816. If you get this number and this number, should give you the starting point, 4184. 4184. Your job is done. That's how you're doing this accrual for the interest expense and premium bonds payable on the reporting date, and how you get rid of the payable and adding the interest expense and premium for the other 4 months. Because in total you have to have 6. 2 plus 2 plus 4 is 6. So you have this one is your interest expense. Let me grab it for here. That will be interest expense. And that's your premium. Same thing here, interest expense, premium. So that will be in that color, that will be in our yellow. And we're gonna get those two and format it, boom, done. Now I can post you this Excel spreadsheet, which I'm gonna save it here. And go to the Blackboard, edit. So now you have so many versions of this Excel spreadsheet. I don't want to download it. I'm gonna delete it, delete, and file and download the new one, the new version, and you have it saved right now. It's all for you. Let's see now what's left on the slides. So again, on the slides, we're gonna split the 6 months into 2 portions, 2 months and 4 months. And we're gonna do the accrual entry for the reporting date with creating interest payable. And then on the payment date, we're gonna close the interest payable. Then we're gonna add the interest for the other 4 months, premium for another 4 months, and we're gonna clear everything with cash. Again, that's the calculation here that they're showing, the same calculation that I show you by splitting it 2 plus 4. This is for the reporting date. This is for the payment date. Reporting date corresponds with the accounts, the interest payable. On the payment date, you're clearing first the interest payable, adding the extra interest expense and the premium deductions, and you're back on track. So the retirement and conversion of the bond. Now on the retirement of the bond, you have few options here. First one is if you want to retire them early. If you want to retire the bonds early, first you have to clear all the sorry, let me see I wanted to record this class. It's kind of loud. Yes, it's recording as we speak. So to retire the bonds, first option is we pay all the interest and we just, at the end of the life of the bonds, we just close them. Second option is when we hold the bonds before the expiry date. Why somebody wants to call the bonds and pay the bonds before the expiry date? Imagine this, I'm paying on my bonds 6%. Suddenly the market went down to 1%. So the amount of paying on the expenses for me is ginormous. Then I'm going to do simple calculation, not here in this class. Don't get me wrong, we're not doing that calculation. This will be in the finance course. If you take the finance course, what you're going to do is, because you have to pay penalty. Because if you retire them before the interest payment, you don't have to pay the interest. That's the tricky part with the bonds. So, what you're going to do is you're going to make a simple calculation. If with the penalty that you have to pay, plus the save of the interest, and issue the new bonds on the low interest, if you have positive cash, go for it. If you're negative, stay where you are. That's on the pure financial point of view. That's the reason for somebody to retire the bonds. Now let's pretend that we have two options. One option is to call the bonds on specific price. Second one is to convert them into the shares. If you are in reality, if you're able to convert bonds to share, that probably is the best thing. Why? Because you'd never have to pay the principal. You just give them shares, end of the story, done. They become owner of the company, case closed. You're not paying the bonds. So now, journal entry, in reality, what's happening in journal entry is the same as the other cases. Now for most likely they either is going to be discount, either is going to be a premium. When the bonds are retired before the maturity, first we have to record the partial period amortization from the premium or discount for the months that are between the last interest payment up to the date that we're retiring the bonds. Then we have to write off the portion of the premium discount that relates to the portion of the bonds being retired. If we retire entire amount of the bonds, entire premium and discount is going to disappear. If we're retiring half of the bonds, half of only the premium and discounts will disappear. And then we have to calculate the loss or gain on the retirement. So our calculation will be this. Let's say $10 million callable bonds with unamortized discount of 40,000 are retired. Market price is 99.50. We paying, instead of 99.50, we paying premium 103. So what's going to happen? We're retiring the bonds at 99.50 because we're paying the market price, not the call price. We're paying the market price. So the face value of the bonds is 10 million. They have unamortized discount 40,000. So the carrying value of the bond is 9,960. We're paying the market price. If we have to choose between the call price and market price, we're choosing the market price since the market price is lower. And if we do that, we can generate gain on the bonds of $10,000. How this going to look at the journal entry? We're closing the bonds of 10 million. We're paying the cash of 99.50. We're closing the discount and working out on the gain and loss. What I want you to remember here is there's no difference between selling asset with accumulated amortization and selling bonds with the discount or premium. So what you have to remember, the assets. Once you sell the asset, first get rid of the asset. Second, get rid of the amortization. First, record the amortization up to the date of the sale, then get rid of the amortization. See how much cash you get, balance your entry. If you need debit, you're losing. If you need credit, you're gaining. Same idea with the bonds. First, update amortization schedule. Second, get rid of the bonds. Debit bonds payable, gone. Get rid of the discount attached to the bonds. Credit discount, bring the discount to zero. See how much cash you get, and then do the calculation. If you need debit, you're losing. If you need credit, you're gaining. End of the story. Keep it simple. That's my point. Now convert the bonds into the notes. If we have the exchanging the bonds to the common share, again, that's the best thing that you can do. Basically, you capitalize your bonds, and then you don't have to pay it anymore. But now the number of the common shares is going to increase. What can happen is some of the shareholders may reduce they decrease their percentage of the ownership of the company. Now, disadvantages and the advantage of the borrowing. What is the advantages, disadvantages? Now, shares. So what should they do? Should they use the shares to raise the capital, or should they bonds to raise the capital? Shares, when using the shares, you're giving up ownership. When you're issuing the bonds, you're just using money. Now, on the payments, on the shares, once you get the money from the shares, you don't have to pay the money back. Bonds, you have to pay the money back at the maturity date. In the meantime, on the bonds, you have to pay interest. Where on the share, you may or you may not pay the dividend. Now, where's the tricky part here? The interest that you're paying on the bonds are tax deductible, where the dividend is after taxes. By issuing the bonds, you may create high return for the shareholders. When you issue the shares, you're basically lowering the earnings per share. So let's see how this is going to work. Let's see issuing the bonds versus shares. This company has a net income of 600,000 and have 200,000 common shares outstanding. The company needs $1 million. So one option is to issue $1 million by issuing 10% bonds, which pay 10% interest on the bonds. The other option is to issue 100,000 common shares and to raise $1 million. So now watch this. If you raise the borrowing, now the net income before issue the borrowing 600,000. Interest that you have, income before the interest and income taxes, projected income before interest and after the interest income taxes, before interest and income taxes is that much. Now we have to pay the interest expense, which is 100,000. Now projected income before income taxes is that much. We're paying 40% income taxes. Now projected income 120. Now the company total net income is 600 plus 120, 720. Divided by 200,000 shares, earnings per share is 360. Now let's see, issue the same capital, raise capital, but now from the bonds. Now on the bond, issuing the common shares. We don't pay anything in the common shares. Dividend is not tax deductible, so our tax is gonna be high with 40,000. Now our company income will be relatively higher, but the number of shares went too much with 100,000. So earnings per share went $1 down. Again, depends what kind of effect you're looking for. Now, long-term disability, long-term liabilities, other long-term liabilities, what will be with that? That will be something interesting, but let's do it. Let's cover it next time. That's mortgage payable. I want you to know about mortgage payable. That's why I'm going to leave it for next time. Okay? And I'm going to show you some mortgage payable stuff. So on the mortgage payable, if you want, right now I can show you something. Stay with me for a second. Let me open one window here and share my screen. Can you see my screen?
I can see it.
Now I want you to work with me here. Go to mortgage calculator. And you're going to see so many different calculators. Royal Bank, Scotia Bank, Canadian Mortgage Housing, TD, some other things. Which I want you to choose is the one that's coming from the Financial Consumer Agency from Canada. Check this one. And as you can see here, it's now we're going to the Government of Canada kind of website. Once you go here, what you have to just plug the numbers. Let's pretend we're buying house in I don't know where. In Burnaby. Let's go buy a house in Burnaby. The house price is $1.2 million. No, let's go with condo. Condo in Burnaby, it's $650,000, one bedroom. So we have 20% for down payment or 25% to avoid the insurance. 25% we're gonna put 650,000 time 0.25%, we have 162,500. So the borrowing amount that we're looking from the bank is 650, 1, 2, 3. So we're looking for 487,500. So mortgage amount will be 487,500. 487,500. Now we're going to the interest rate. Interest rate, we can easily check some interest rates here. Mortgage interest rate. And they're going to give us some percentages here. Let's go to current rates. Let's go to National Bank and see what's the accept. That's too much. Forget this much. Let's go to TD. So if we look at those one, special rate, they don't posting anything. Forget about this one. One city, no, CIBC. Let's see what's CIBC. They learn more. I don't want to learn more. Leave me alone. So let's go with this. Some simple mortgage interest rate, current mortgage interest rate Canada. Let's go with this one. Compare Canada mortgages. That's why I'm buying home. No, I'm not buying. So what you can see here the mortgages, different mortgages. 4.29, 369, 379 for different purposes. Let's stick with something like 450. Let's go with 450 on our calculation here. 4.5%. Amortization period, we're going to leave it 25 years. On the payment frequency, choose if you have to do the mortgage, always go bi-weekly. Bi-weekly, you're making the most available saving that you can. 5 years term, obviously, we're going to stay on the 5 years term. Prepayment, we're not going to make any prepayment. And we're not going to do the calculation. So if you have to borrow from the bank 487,500, 4.5% over 25 years, for the first 5 years of the mortgage, you're going to have 130 payments. Over the entire mortgage, you're going to have 650 payments. Your mortgage payment amount bi-weekly will be 1,244.64. Principal amount that you're going to pay over the 5 years. First 5 years will be 59. The interest that you're going to pay over the first 5 years will be double of the principal amount. So the total cost for the first 5 years will be 161,802. Over the life of the mortgage of the 25 years, you're going to pay the amount that you borrow, plus you're going to pay $321,514 interest. In total, you're going to pay almost double. So now, this is again summary. If you want to see the diagram, you can see the diagram. If you want to see the summary report, you can click here, summary report, and you can scroll down and you're gonna see this beautiful chart. Which chart's gonna tell you on the very first payment, how much will be the principal, how much is the interest, how much left. Next payment, how much is the principal, how much is the interest, how much you're paying, what's left. And keep going, keep going, keep going. What you can see here is what I wanted to chase is at which year the interest and the principal become equal. Let's see which years will be that. At year 10, on the payment 246, your principal finally become 47, your principal become more than the interest. But look at how much is the principal left. 361,000. So at this point you pay just a little bit over $100,000. This is on the year 10, people. After 10 years, you're gonna pay just about $100,000. Now you have another 15 years to pay. So where is the opportunity here, if you ask me? If you ask me, the opportunity will be going back, and the opportunity is to do prepayment amount. And let's say we prepay every year $20,000. One time, no. Each year, we're gonna pay it each year. When we're gonna start with the, let's say, with the 20th payment, 26th payment, at the end of the first year, and the next year, and the next year, and the next year. So what's gonna happen if we do this? If you put every year $20,000 on top of what we're paying, watch this. Over the life of the mortgage, you're gonna save $172,000 by putting $20,000 every year. Can you believe this? You're saving $172,000. Isn't that amazing? Over 25 years. And this is the breakdown of the mortgage. It's a very, how can I say, very educated. So look at this diagram. This is another thing. If you don't do prepayments, that's how your mortgage is gonna look like. If you're doing the prepayments, that's how your interest payment's gonna look like. This is the payment of the interest without prepayments. This is the payment of the interest with the prepayments. Amazing, isn't it? So here is the summary. On the 25 years amortization, over 5 years, at the end of the balance is this one. So here's going to tell you at the end of each year, how much is the balance left. Now, where is the prepayment savings? So by the end of the amortization period, with early payment 20,000, you save 172,000 on the interest and pay your mortgages of 152 months sooner if you don't have it. 152 months sooner, people. That means you're going to pay your mortgage 152 divided by 12 years earlier. Instead of 25 years, you're going to pay your mortgage within 13 years.
So that's why it's important to save up money for the long run.
All right. This is simple example how with money you can make money. By just saving 20,000 every year, put it towards your prepayment on the mortgage. Over the life of your mortgage, you're gonna make $172,000. Just like that. Don't ask me if you put higher prepayment. Monica, this is a good calculation. Look at it, explore it, play different scenarios, and based on this, make the best choice that you have to make. You have it available. I wanted you to see it. So now next time we can talk about the mortgages and how the mortgage payments going. Again, this page, you can find it when you click the mortgage calculator. And this is from the Government of Canada. And that's called Mortgage Calculator Financial Consumer Agency of Canada. Okay, that will be it for today, people.